Welcome to Libertex. Whether you're new to trading or a seasoned veteran, mistakes are a part of the journey. In this video, we've put together the top 7 most common trading mistakes to avoid in order to help you get more from the markets and open and close your positions with confidence. These 7 beginner trading and investing mistakes will save you time, stress, and ultimately thousands of dollars in savings. So without further ado, let's get started with the top 7 most common pitfalls to avoid in the markets. The first trading mistake in our top 7 is getting advice from people who are not certified professionals or financial advisors. Opening positions based on what your friend, coworker, hairstylist, or barista tells you is a mistake made all too often in the markets, and one that could lead to painful losses. The second trading mistake, following getting advice from the wrong people, is not doing your own research and due diligence before opening trades. Always pay attention to where you are getting your information and advice from. One of the many advantages of the Libertex platform is that traders can receive breaking signals and updates on the assets they are most interested in, with credible information that can be leveraged in the markets. In addition to using Libertex as a source, there are other valuable sources of information and credible publications. Just be careful that what you are reading is not solely based on a rumor or in an online forum. Similar to trading, you never want to put all of your eggs in one basket. When you are doing due diligence, make sure you are comparing different credible sources to formulate your opinions and to fully understand the pros and cons of a potential investment. Never invest in an asset that you do not understand or in a company that you don't know what they do. This mistake leads us to our third most common trading mistake, and that is investing all of your money in one stock, cryptocurrency, or other asset. This is never a good idea. In order to achieve long-term success in the markets, you need to be diversified. If you have all of your money in a particular stock, for example, and then bad news or a catastrophic event happens, there is nothing else in your portfolio to offset the loss, and now the entirety of your investment is falling deep into the red. The temptation of throwing all of your money into one asset in a YOLO might be hard to resist if an asset has made big gains. But often, by the time you are considering doing this, the asset has already exhausted itself. That's why it's necessary to spread your money out across different sectors, be it tech, automotive, pharmaceuticals, or metals. The important thing is to just not give in to temptation and focus on the journey with sustainable growth. Our fourth trading mistake to avoid at all costs is buying high and selling low. When traders and investors see a stock or asset and it's up multiples of percentages day to day or over a short period of time, the temptation to get in on the action is common. However, this often leads to big losses as assets tend to go through cool-off periods after big runs. What traders and investors should do in order to avoid this pitfall is to instead embrace red days and view them as fire sales to get strong performing assets for cheap ahead of their next run into the green. Some even take this farther and only purchase assets on red days. Whatever the situation for you might be, do your research as to what price ranges a particular asset trades at normally, so that you can understand whether that asset is a good deal when it falls or increases in price. Buy red, sell green. This leads us to our fifth trading mistake often made by beginners, which is not understanding the difference between day trading and investing. For some of those who are new to the markets, many carry unrealistic expectations about turning $1,000 into $100,000 in a week, along with other misplaced assumptions about the markets. When traders have these expectations, they are not thinking rationally, and in almost every case, they lose money. Instead of trying to be a multi-figure day trader, a much better approach, especially when starting out, is to view yourself as an investor. The key difference is that with investing, you are in it for the long haul, with building wealth over time and not overnight. This significantly decreases the risk in comparison, and you are more likely to avoid serious loss. This is not to say that we don't practice day trading or swing trading, but the best traders do so with controlled investments, while maintaining the majority of their investments in long-term holdings in companies they have confidence in. Our sixth trading mistake to avoid at all costs is panic selling. It's important to realize that a loss is not incurred until you sell your positions if they are below where you originally bought them at. It's a very common flaw of trading psychology to panic and lose focus of the long-term belief you held firmly at the time of purchase when a stock dips below your buy-in price. When this happens, ask yourself if anything has fundamentally changed to the company or asset in question. Are they still perfectly functioning? Then relax. Fluctuations happen, and if you are investing with a time frame of several years, you often have little to worry about. Furthermore, as investors, you should consider averaging down on your positions when this happens. If and when an asset that you believe in drops in price, you can pick up more of it and lower the average cost of your investment in preparation for the next leg up. Our seventh and final trading mistake to avoid at all costs is not having an exit strategy. While we are fans of long-term investing, often between 3 and 5 years, when you open a trade or investment, you need to know the levels that you will be happy with exiting at. If there's anything to know that it's never a bad thing to take profits if you are up. Staying true to your exit strategy is a critical distinguishing factor between successful traders and unsuccessful traders. Especially when an asset is up nearly triple digits, consider getting out. Don't get greedy when an asset runs up, because in over 95% of the time, there will be a cool-off period, and oftentimes you will have a chance to get back into the asset if you truly believe in it running back up again. So there you have it. The top 7 mistakes to avoid whether you are trading or investing that will save you money, agony, and needless stress in the markets. Have you ever made some of the mistakes we discussed? We'd love to hear about some of your biggest trading mistakes in the comments section, so write in to join the conversation with our analysts and community of traders. And if you'd like more weekly content on the hottest stocks, cryptocurrencies, and the latest trade-related developments, make sure to subscribe to our channel and like this video to support us in our quest to bring you the top quality content from inside the markets. If you're starting out on your trading odyssey, check us out at libertex.com and open up a free trading account to get access to one of the top places to trade stock CFDs, crypto, and over 200 unique instruments without the hassle and fees of other competing platforms. We hope you enjoyed this video and wish you all the success in avoiding these mistakes in order to see more wins in the markets. Thanks for watching, and see you next time.